Good day, friends. Today we will discuss investment decisions and discount cash flow method. These are basically under income approach method. With the discount cash flow method, we can find out whether a project which you are doing investment is viable, will it produce some profit or not. So this discount cash flow method is generally used for investment decisions. And then we will discuss about how to assess the risk in your investment in this topic. So first we will discuss that how you will make investment decision, what are the factors which affect investment decision. So we will discuss factors which will affect investment decision. So investment in real estate can be a rewarding venture if approached with careful planning and consideration. This is important thing. Whenever you are making an investment in real estate, what you have to do, you have to do it with careful planning and considerations. So, what are the factors which will affect your investment decision? First thing is locations. So, you know the location, it is the most important thing in real estate. So, saying location, location, and location, it remains crucial. So, for residential properties, what you need as far as location is concerned, it needs proximity to amenities, green spaces, scenic views, and neighborhood status, which significantly impact residential property value. And as far as commercial properties are concerned, closeness to markets, warehouses, transport hubs, and tax exempt area is vital. Then whenever you have to make investment decision, you have to do market research about local real estate market trends. So if you have to understand the local real estate market trends, which is very essential for any investment decision in real estate. So what you have to do in market search, you have to analyze property values, rental rates, and the economic outlook of the area. So researching for that, what you have to do, you have to research past projects and the reputation of construction companies which are available in that area, that can also provide insights. Then property conditions. So you have to check whether it you need to invest in new constructions, or you can invest in existing properties. It's important to review property deeds, recent surveys, and appraisal reports. Consider the cost of maintenance, outstanding dues, and taxes against the property of which you are in which you are making some investment. Then you have to do financial analysis. In financial analysis, you have to check what is the rate of return on the investment, that how much you will earn on this investment. For that, what you have to do, you have to consider all expenses including closing cost, financial financing fees, repairs, utility, property taxes, and of course insurance. So understanding potential market value after renovation is crucial. Then risk management. In risk management, what you have to do? You need to diversify your investment portfolio. What does this mean? Means you have to invest not in a single type of property. You must invest in multiple type of properties such as residential, commercial, and industrial. And of course, you can do otherwise also in investment, other investment methods, just as direct ownership, REITs, crowdfunding, etc., to spread risk. So next is legal consideration. Whenever you are buying or investing in some invest in real estate, this legal consideration is very important. So the investment which you are in which you are investing, it you have to ensure that it comply with the local zoning laws, building codes, and other regulations as stipulated. So far, if you need some help, you can consult some legal expert who can help you to navigate these complexities and avoid potential legal issues. Then sustainability, which is very important these days, green buildings and other sustainability uh, things which are very important. So green buildings are properties with energy efficient features. These are very important these days. What they can do, they can enhance long term value and appeal to environmentally conscious tenants. Next is your discount cash flow method. So what discount cash flow techniques? So basically discount cash flow techniques, they are applied for assisting in making decisions relating to property investment and appraisal. So basically, whenever you are investing in real estate, you have to make financial analysis to check whether your investment will be profitable or not. So for that, there are certain methods which are under the this discount cash flow techniques. So by using these techniques, you can find out whether the project is profitable or not, or viable or not. There are many methods, but here we will be discussing two methods. First method is net present value method. So in this case, what we do, let us suppose you invest 1 crore in a project, and this project is in the first year give you a return of 10 lakh. In second year it gives you a return of 25 lakh. In third year it gives you a return of 35 lakh. In fourth year it gives you a return of 45 lakh. And fifth year it gives you a return of 45 lakh again. And in the end you were able to sell it for certain amount, say for 1 crore 50 lakh. So what do we do here? This is your initial investment. This is called initial investment. We donate it with C, and return at the end of first year it is donated by G1. At the end of second year it is donated by G2, G3, G4, G5. These are the things which will you will receive. So what we do, we find the present value of all these future cash flows. How we can do, we this is at the end of first year, so we will multiply with this 10 lakh with the present value factor. For present value factor, present value factor, it is equals to 1 over 1 plus r raised to power n. For first year, value of n is 1. R, what is R? R is your expected or target rate of return. So R is your target rate of discounting, and C is initial cost of the project. So what we do, first of all, we find out the present value of all the future cash inflows. For first year, you will divide it with 1 plus r raised to power n. Second year's cash flow will be divided by 1 plus r square, plus third year it will be divided by 1 plus r cube, and so on, 1 plus r raised to power n. From this is present value of all the future cash flows. From it we will deduct initial outlay or initial cost of the project. So that will give you net present value. Now with from the this value we will check three things. First we will check whether net present value is greater than 0. If net present value is greater than 0, it means what it means? It means that discounted value of future cash flows is greater than the initial investment. So what does this mean? It means you will be getting a higher rate of return than you desire, means investment of the project is profitable. So let us suppose your target is 14%. So if NPV is greater than 0, it means you will be achieving a target higher than 14%. But if it is equals to 0, it means you will be achieving a target equal to 14%. And if it is less than 0, it means you will be receiving achieving a target of less than 14%. So if it is equals to 0, it means you are able to achieve the target equals to your targeted rate of return. So it means it will be exactly equals to return you desired. And if it is less than 0, it means you are getting a lower rate of return than you desired. It means the investment as the project is not profitable. So if if NPV is equals to 0, this rate the rate at which net present value is 0, that rate is called internal rate of return. So in other words, so what this NPV represent? It represents an absolute measure of value, whereas IRR, it is a relative rate of return. So there is difference. This is absolute and this is relative rate of return. So we will be taking some examples that will make the things clear. So first we will be doing an example on net present value. So the initial cost of two projects A and B is same 3 crore, and their net annual return pattern for 3 years is as follow. This project A, it will get a cash flow of 2 crore in the first year, in the second year 4 crore, in the third year 5 crore. And project B, it will achieve a target cash flow of 3 crore in the first year, in the second year 1 crore, in the third year 4 crore. So if the target rate is 14%, find out the ranking of the two project. Means we have to check which of the two project is more viable. So first we will find, so for that what we will do, we will find net present value of both the projects. So here C in both the cases is C is equals to 3 crore. Okay, and G1 G2, and represents the net annual returns for the first, second and third and nth years respectively, and you know the formula net present value G1 over 1 plus r raised to power n 1, and so on. You know this formula, we have already discussed. So we put all the values here. First year 2 crore divided by target rate is 14%, 1 plus 0.14 raised to power 1. Similarly 4 crore divided by 1 plus 0.414 raised to power 2. Similarly third year 5 crore divided by 1 plus 0.14 raised to power 3, and we deduct initial outlay which is 3 crore from this present value. So this will give you net present value. If you calculate it, it will comes out to be rupees 5 crore 20 lakh 96,874. Similarly, for the project B, you put all the values. First year it is 3 crore, third year it is 1 crore, and second year it is 1 crore, third year it is 4 crore. You divide it 1 plus 0.14 raised to power 1, 1 plus 0.14 raised to power 2, 1 plus 0.14 raised to power 3, and we deduct initial investment of 3 crore. So this will come out to be 3 crore 10 lakh 9,000. So it means this project is more viable than the project B. So otherwise you can find out with the help of Excel also. For project A you put this in an in a cell in Excel equals to NPV. This is the formula. NPV bracket shuru bracket starts 14% comma 2 crore plus 4 crore 5 crore. You put all the values, it will comes out to be 8 crore 20 lakh 711. You deduct 3 lakh 3 crore from it, is 5 crore 20 lakh 711. Similarly for project B you can do the same in the Excel format also. So it is easier to calculate this in Excel. So the second is internal rate of return. So in internal rate of return, it is a financial metric used you to evaluate the profitability of an investment. So it represents a discount rate at which the net present value of all cash flows, means both inflows and outflows from a project or investment, is equal or equals to zero. So essentially, IRR is the annualized rate of return that makes the present value of future cash flows equals to the initial investment. So here, this the discount first in the net present value. This target rate was given to you 14%. See here, but in internal rate of return, you have to find the target. Your aim is to find target rate of return at which net present value is equals to zero. It means if that net present value is zero, means present value of all cash flows equals to initial investment. Okay, so for that, what we have to do, we have to find this target rate by trial and error method, and which equates the discounted cash flows benefits with initial and outlay capitals. Then IRR is equals to R1 plus N1 over N1 plus N2 multiplied by R2 minus R1, where R1 is lower trial rate, R2 is higher trial rate, N1 is net present value at lower trial rate, and N2 is net present value at higher trial rate, irrespective of the sign. And IRR is desired internal rate of return. So to make the things clear, we will do it one example that will make this formula clear to you. Find the IRR of the following investment. Initial outlay capital is 9 lakh 10,000. First year rent is 2 lakh. Rent for second year is 3 lakh. Rent for third year is 3 lakh 50,000. Rent for fourth year is 4 lakh. So you have to find IRR. So we will do trial and error. So let us suppose we try at 12%. So at 12%, present value at 12% means you put this formula 1 over 1 plus 0.12 raised to power 1. That factor will come out to be 0.8929. So cash in is 2 lakh. So discount cash flow will be 1,78,571. Similarly, for second year, present value factor will be 0.7972. 3 crore is a cash inflow. So discounted cash flow will be 2 crore, 3 lakh is a cash in, and the discounted cash flow is 2,39,158. Third year present value factor is 0.7118. 3,50,000 is the cash in. So you multiply present value factor with the cash in, it is 2,49,123. Similarly, fourth year present value factor is 0.6355. 4 lakh is the cash in. Discount cash flow is 2,54,207. You add all these three, it is 9,21,060. And out less out initial outlay 9,10,000. So the net present value is 1106, which is positive. Now see, in the next we try at 13%. At 13%, so 1 plus 1 over 0.13 raised to power 1, it will be equals to 0.8850 with present value factor at 13% for first year. So 2 lakh is cash in, it will be 1,76,991. Second year present value factor is 0.7831. 3 lakh is cash in, 2,34,944 is discount cash flow. Similarly, you can find out for third and fourth year also. So you find this value comes out to be 8,98,547. So it is less than the initial outlay, which was 9,10,000. So the value comes out to be 11453. And so the value at 12% was equals to 0.11060, and at N2 it is minus 11453. So this is net present value at a lower trial rate at 12% means, and at higher trial 12% at 13% it is 11453, and the lower trial rate is 12%, higher trial rate is 13% in this case. So you have to do hit and trial until value changes from positive to negative. One of the value should be positive and other value should be negative. So then you have to use this formula. R1 is lower trial rate, N1 value at higher trial rate 11060, then N1 plus R2 value at higher trial rate plus value at lower trial rate multiplied by R1 minus R2, higher trial rate minus lower trial rate. So see here, though the value is 11453, so you have to do here, take this value as positive. So minus 1 to minus with that will be positive. So this value comes out to be 12.49%. So it means if you calculate the value at 12.49, the net present value will be equals to 0. So you can do it with interpolation also, which you have been doing during your graduation. So value at 12% is 11060, value at 13% is minus 11453. So there is total reduction of 11060 minus 11453. So total reduction is how much it reduce with the increase of 1% target, it is 1%. So for reduction of 2 to 1, this is 2 to 1,513. Percentage increase by 1 for reduction of 11,060. So you have to make it 0, you have to reduce this much amount. So for reduction of 11,060, increase in percentage should be 1 upon 2 to 153 multiplied by 11069. It is 0.49. So your required IRR is 12 plus 0.49, 12.49. So either you can do interpolation in this way, or you can do use that formula directly, and otherwise you can use Excel. So you put the values in the Excel in this way, minus 9,10,000. So your initial outlet will be written with minus, and other you can put these values. You put this formula equals to IR A1 to A5. So you put this, it will come out to be approximately equals to 12.52, which is nearer to the which you have find out manually. So you can do it with Excel also. Then terminal value. So terminal value is estimation in real estate valuation is critical step when using the discount cash flow method, as it represents the value of all cash flow beyond the forecast period. So see here, we have used calculated it for 4 years. In the first question, we have calculated it for 3 years. So that what happens after 4 years or 3 years? So that for that we use future value of all future cash flows beyond the forecast period. For that we use terminal value. So there are two methods for calculating the terminal values. One is perpetual growth model. So in this case as well, the this model assumes properties cash flow will grow at a constant rate indefinitely. For that, you will be using this formula: terminal value is equal to CF1 plus n plus 1 divided by R minus G. This CFn plus 1, it is cash flow in the first year after forecast period. R is discount rate and G is perpetual growth rate. So let us suppose, for example, final year cash flow is 1 crore, rate of return is 8%, perpetual growth rate is 2%. So terminal value will be 1 crore divided by 0.08 minus 0.02. So it will be 1 crore 66 lakh 67 667 66,067. So second method is exit multiple approach. This approach applies a multiple such as capitalization rate to the final year's net operating income. So in this case, we will be multiplying certain multiple with final year's net operating income multiplied by exit multiply. Let us suppose final year's income is 1 crore 50 lakh and capitalization rate is 7%. So you can find out the terminal value by multiply it with in this way YP, which is 1 upon R. So you can find out the terminal value in this case 2 crore 14 lakh 28,571. So if you have to do discounting, what you can do, you can find the present value of the terminal value by formula terminal value divided by 1 plus R raised to power n. So this value will be added in your net present value you have calculated. So for example, terminal value is 1 crore 66 lakh 66,667. What we have calculated in the first example, rate is 8% and forecast period is 5 year. You do its present value of terminal value will be 1 crore 13 lakh 209. Then where terminal value is used, terminal year value is generally used in discount cash flow analysis. So it estimates the value of an investment based upon expected future cash flows. So terminal value accounts for all future cash flows beyond the forecast period. So when, for example, when valuing a commercial property, you forecast cash flow for the next 5 to 10 years, and after that, what we calculate terminal value, find out its present value, then we add it to the value which you have calculated as net present value. Then for real estate development projects, you use this terminal value. It is used to estimate the future value of a development project once it is completed and operational. For example, a developer planning a new office building will calculate the expected cash flow during the construction phase and use the terminal value to estimate the building's value once it is fully leased and generating stable income. Then for investment decisions, you can use investor use terminal value to evaluate the long-term profitability of real estate investment and make informed decision. For example, an investor considering purchasing a rental property will use terminal value to understand the property's value at the end of investment horizon, helping to assess potential returns and risk. Then asset disposal or exit strategy. So terminal value helps in estimating the selling price of a property at the end of investment period, which is critical for planning and exit strategies. For example, in real estate investment trust may use terminal value to estimate the future sale price of its properties, aiding in portfolio management and exit planning. Then for financial reporting purposes, companies use terminal value to estimate the fair value of their real estate assets and present accurate financial statements. For example, a company owning multiple properties will use terminal value to estimate the fair value of its portfolio, ensuring that its balance sheet reflects the current market value of all its assets. So you can use terminal values in these cases. Then next important thing is CAPM. It is capital asset pricing model. So it is basically a financial model used to determine the expected return on investment based upon its inherent risk. So in the context of real estate in India, CAPM can be applied to evaluate the potential return on real estate investment by considering risk associated with the market. So here we will calculate how the risk associated with the market is determined. So first that you must know there are two types of risk involved in the investment. There are two types of risk. First one is systematic risk. These are the risks over which the investor does not have any control, such as changes in government policy, such as demonetization, changes in RBI policy, and changes in Companies Act. Unsystematic risk, these risks are differ from company to company. So these are for all the companies systematic risk. But unsystematic risk, these differ from company to company. These are same for all the companies. So let us suppose, for example, we take the example of JSW and Tata Steel. Suppose Tata Steel was getting orders from the government, but this year orders were given to JSW instead of Tata Steel. So thereby the shares of Tata will come down. So in order to nullify unsystematic risk, an able investor with what will do? It will diversify and invest in many steel companies instead of only one company. So now only risk he will face will be systematic risk. So systematic risk is measured through a term which is beta. So what is beta we will discuss now. So key components of CAPM. First thing is risk-free rate. You must know what is risk-free rate. This is a return on an investment with zero risk. So typically represented by government bonds, the return which they are giving, that is risk-free rate. Then beta. So beta is defined as sensitivity of changes in the security rate of return of a particular company with respect to the changes in the market rate of return. So beta is basically percentage change in the security rate of return of the particular company divided by percentage change in the market rate of return. So first thing you must know what is these two terms. Security rate of return of particular company and market rate of return. There are two things which you must know. So whenever you enter in the share market, you purchase the share of a company. What you have first thing you will enter a market. So market it will have some its market rate of return. And when you enter into the market and buy the share of a company, this company will have security rate of returns. So you have to confront with these two things. This is market rate of return of the whole market and security rate of return of that particular company of which you are purchasing shares or securities. So what is beta? Beta is change in the security rate of return of a particular company divided by percentage change in the market rate of return. For example, let us suppose market rate of return was 10%. When market rate of return was 10%, security rate of return was 12%. When the market rate of return changes to 15%, security rate of return changes to 19%. So beta will be 19% minus 12%, which is percentage change in security rate of return. 19% minus 12% of that particular company divided by 15 minus 10 rate of percentage change in market rate of return. 15% minus 10% means 7 upon 5, which is 1.4. So if the stock is riskier than the market, it will have a beta greater than 1. So if a stock has a beta less than 1, the formula assume it will reduce the risk of a portfolio. So second thing in this case is market rate return, which is we denoted with RM, the expected return of the market as a whole. Then market risk premium. What is market risk premium? RM minus RF means additional return expected from the market over the risk-free rate. So CAPM formula, it is equals to KE. We donate with KE. It is RF plus beta multiplied by RM minus RF. So where this CAPM model is used, it is application, it's in real estate. How it is applied in real estate? It is used to estimate returns. CAPM helps in estimating the expected returns on a real estate investment by accounting for the risk-free rate and the market risk premium and the specific risk rate beta associated with the real estate market. So first thing, it will be used to estimate returns. Second, it will be used for risk assessment. So by analyzing beta, investor can understand how sensitive their real estate investment is to the market changes. So it will help in making informed decisions about the portfolio portfolio diversification and risk management. Then for investment comparison, it is also used for investment comparison. CAPM allows investors to compare the expected returns of real estate investment with other asset class, aiding in better allocation of resources. Let us suppose we take an example. Suppose an investor is considering and investing in a company XYZ stock. The risk-free rate is currently 3%, RF is 3%, and expected rate of return on the market portfolio is 10%, means RM is 10%. Company XYZ's beta is 1.2. Beta is 1.2. You have to put all the values. It comes out to be 11 point KE comes out to be 11.4%. So on the basis of let us suppose you calculate this, it is 11.4%, and but if based on the current prices the total return is only say 8%, then it is not compensating investors fairly for the risk he takes. So it is overvalued risk associated with the investment. So how it is, we will discuss in the next slides. So what is the that it will make the things clear. So how it is used? Well, you should know the relationship between risk and return. Higher the risk, higher will be the return. Lower the risk, lower will be the return. So risk and return relationship is higher risk, higher potential return. Investment with higher risk levels typically offers potential for higher returns. Why? This is because investors demand a premium for taking additional risk. Then for lower risk, lower potential return, there will be lower potential. Means conversely, investment with low risk level generally provide lower returns. Why? Because investors are willing to accept low returns for the perceived safety of their investments. So then we will discuss what are the factors that influence risk and return in real estate. So we will apply these things particularly for real estate. For location, so property, these factors will affect risk and return. First thing is location. So property in the prime locations tend to have higher returns, but also see here, though they will be having higher returns, but also higher risk due to market volatility. In that case, market will be more volatile in case of prime locations. Then property type. So different properties, for example, residential, commercial, industries have varying risk and a return portfolio. So as you know, commercial property might offer higher returns, but the thing is, it also comes with higher risk compared to residential properties. Then market conditions. Real estate markets can be cyclical with periods of booms and busts. So understanding market trends is crucial for assessing risk and potential risk. You know, sometimes it is buyer's market, sometimes it is a seller's market, sometimes there is boom, or sometimes there is bust. So you have to understand market trends for because it is crucial for assessing risk and potential returns. Then economic factors. So you know interest rates, inflation, and economic growth impact the real estate values and returns. For example, rising interest can decrease the property's value, and of course they will decrease the returns. Then tenant quality. The creditworthiness and the reliability of tenants affect the rental income stability and risk. Higher quality tenants reduce risk and enhance returns. Then property management. So effective property management can mitigate the risk and enhance returns by maintaining property value and ensuring high occupancy rates. For example, consider two investment property. Property A located in a prime urban area with higher rental demand but also have high property prices and market volatility. And property BC here, higher rental demand, but it has high property prices and high market volatility. And property B, located in a suburban area with moderate rental demand, lower property prices, and more stable conditions. So, what will you conclude from here? It means property A might offer higher potential returns due to its prime location, but comes with a high risk due to market fluctuations. And property B might provide more stable returns with lower risk due to stable market conditions. So, what it includes, so we should make a balance between risk tolerance and return expectations when investing in real estate. So basic thing is diversifying. So diversifying your investment across different property types, different locations, they can help manage risk and while optimizing returns. So this is all in this video. So please like, share and subscribe our YouTube channel, youtube.com at the rate values club 07 for more educational videos on valuation and other related videos. Of course, all these videos are free of cost, and if you have any suggestion, please comment in that comment box. Your suggestions are always valuable, always welcome. Thank you all. Thank you very much.